Hey everyone, welcome back to Corporate Dakota. Today TBCVU just filed an 8K about their initial public offering, and I am seeing a few key takeaways that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing essentially marks the public debut of the company, and it is packed with important details about how they're structured and what has happened behind the scenes. So what we're looking at here is a current report filed by Thunderbridge Capital Partners V. Limited, this is a company that has just gone public, meaning its shares are now available for anyone to buy on the stock market. Think of it as their official welcome party to the public investor world. The key date here is the 12th of August 2026. This is when the company officially completed its initial public offering, or IPO. That is the very first time they sold their stock to the public. The company itself is Thunderbridge Capital Partners V. Limited now, it is important to understand that companies like this often start out as shell companies or special purpose acquisition companies, often called SPACs. Their main goal is usually to raise money through an IPO and then find another existing company to merge with, effectively taking that private company public. Interestingly, this company is incorporated in the Cayman Islands, which is a common practice for financial firms. They've also checked the box saying they are an emerging growth company. This means they get to follow some slightly simpler rules for reporting their financial information, at least for a while. It is like getting a bit of a grace period as they get their sea legs in the public market. Now let's dive into what happened. The company just closed its IPO selling a lot of shares. They issued 30,015,000 units. Each unit is like a bundle, containing one share of their company's stock and a piece of a warrant. So they sold these bundles called units at $10 each, which brought in a massive $300 million to the company. That is a lot of money to start with. This cash is usually intended to fund whatever business or merger they plan to pursue next. As part of this IPO, they entered into a bunch of agreements. One of the most important is the Underwriting Agreement. This is the contract between the company and the investment banks like Cantor Fitzgerald, and company in this case who helped them sell the stock. These banks essentially guarantee that they will buy the shares from the company and then sell them to the public. There is also a warrant agreement. Remember those warrants we mentioned in the units. This is the document that lays out all the rules for those warrants. Warrants are like options to buy more stock later at a set price. In this case, each whole warrant allows the holder to buy one Class A ordinary share for $11.5. A crucial one here is the Investment Management Trust Agreement. This is where the IPO money goes. A big chunk of the money raised from the IPO is placed into a special trust account. This money is meant to be used for future business combinations or acquisitions. It is a safeguard to ensure the company has the funds set aside for its main purpose. They also have agreements with their sponsor, which is often the group that formed the SPAC in the first place. There is a sponsor private placement unit purchase agreement. This means the sponsor also bought some units, often at the same price as the public offering, but these are private sales. This leads us to unregistered sales of equity securities. In addition to the public offering, the company sold an additional 747,000 private placement units. These also went to the sponsor and Cantor, bringing in another $7.47 million. These private units have some restrictions, like they can't be sold for 30 days after the company makes its initial business combination. This is typical to prevent immediate dumping of shares by insiders. Now, let's talk about the people running the show. In connection with the IPO, they appointed new members to their board of directors: David Berg, Mary Ann Gillespie, Stuart J. Paperin, and Alla D. Sticker. All joined the board. Some of them also took on key roles in important committees like the Audit Committee, Compensation Committee, and Nominating and Corporate Governance Committee. This is standard procedure when a company goes public, ensuring proper governance is in place. These directors will serve for a 3-year term. This section details what happened with all that money raised. A total of $300,150,000 from both the IPO and the private sales was put into a segregated trust account. This is where the bulk of the IPO funds will sit, waiting for the company to find a business to merge with. The money won't be released until they complete that initial business combination or until a certain time limit passes, usually around 2 years. If they don't find a deal, the company also announced the IPO pricing with a press release on the 12th of August, and then the closing of the IPO with another press release on the 14th of August. These are just official communications to let the public and investors know what is happening. Here is a list of all the exhibits filed with this report. The Underwriting Agreement is listed as Exhibit 1.1. This is the contract that formalizes the deal with the underwriters. Exhibit 3.1 is the company's amended and restated memorandum and articles of association. This is essentially the company's founding document. like its constitution, which has been updated for being a public company. Exhibit 4.1 is the warrant agreement we mentioned earlier, outlining the terms of the warrants. Exhibit 10.1 is the investment management trust agreement, which details how the IPO proceeds held in trust will be managed. Exhibit 10.5 is the private placement unit purchase agreement with the sponsor, showing the terms of their private investment. Finally, Exhibits 99.1 and 99.2 are the press releases announcing the IPO pricing and closing, respectively. And the report is signed by Gary A. Simonson, who is the Chief Executive Officer. This signature signifies that the company is officially submitting this report to the Securities and Exchange Commission. So, what is the big picture here for Thunderbridge Capital Partners V Limited? This filing is all about their launch as a public entity. They've successfully raised a significant amount of capital, around $300 million, which they've placed into a trust account. This is typical for SPACs. Their entire existence revolves around finding a target company to merge with. The key risks now involve whether they can find a suitable business combination within the allotted time, and if that combination will actually create long-term value for shareholders. If they fail to find a deal, the money in trust is generally returned to the public shareholders. Historically, many SPACs struggle to find good deals, and a significant percentage end up dissolving or seeing their stock price plummet after the merger. The clock is ticking, and the pressure is on the management team to execute their strategy effectively. The risk I am watching is the speed and quality of their future business combination. My biggest concern is that finding the right merger target in today's market can be incredibly challenging, and rushing into a bad deal is worse than finding no deal at all. What I'm actually looking for is a clear roadmap of potential targets and a strong rationale for why those targets are good fits for shareholder value. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.